This is TreppWire Week in Review for the week ending September 8th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. U.S. stocks continue to struggle this week as higher interest rates, an uptick in oil prices, and some strong economic news raise the possibility of more interest rate hikes. September has historically been a rough month for stocks. Manus, is this just a healthy pause, or is something more concerning lurking beneath the surface?
I do think it's the latter. I think that when you look at the numbers we're seeing right now, there's nothing that's flashing red at the moment. If we take them from the top, when you talk about the strength of the U.S. economy, we saw a better than expected ISM services report, in fact, much better than expected. We've seen GDP raised consistently over the last couple of months. There are concerns that the consumer is getting tapped out, but we're not seeing any evidence of that in terms of meaningfully higher levels of distress around the U.S. Unemployment still below 4%. I think that was a bit of a shock last Friday when we saw the jump from 3.5% to 3.8%, a jobs number that was kind of middling, and some real sizable restatements of prior months. I think that tells us we're kind of in that sweet spot of not too hot, not too cold, right? We have a couple of economic data points that are showing that the economy is running pretty hot, but we are showing some signs that things are cooling off as well. So I think there's a good chance that we come out of this with either that soft landing or no landing. That's kind of what it seems like. It doesn't mean that there won't be bumps along the way, especially for commercial real estate and more specifically office. And it certainly doesn't mean we can't see a 10% sell-off in U.S. stocks or another 20 or 40 basis point uptick in interest rates. But it doesn't seem like anything is looming that is systemic at the moment. If there's anything really encouraging about the market right now, several analysts have come out and said we've hit a trough in terms of U.S. earnings, right? We've seen earnings kind of decline among the S&P 500 for a couple quarters now. And several analysts are now saying we should start seeing earnings upticks in the beginning of 2024. So when you put it all together, I don't think that this is the roaring 1980s where we're going to see 8 and 9 and 10% GDP coming out of a recession like we did in the middle of the Reagan years. I don't think this is going to be a dot-com run-up type situation like we saw in the late 90s during the Clinton years when everybody was all in on tech. But I certainly don't think that this is either 1990 or 2008 all over again. I think we are going to thread the needle right now on an economy that is neither too hot nor too cold. And it probably is not terribly satisfying for people that write headlines and do news programs. But for those that look to stay employed, see decent wage growth year over year, are not crushed by inflation, and start to see interest rates level off and maybe come down a little bit over time, it's pretty good news.
Yeah, I think everything you outlined, Manus, you could argue pretty strongly that we're threading the needle, as you said, and maybe exit this downturn without any significant bruises. I think, though, there are some things that kind of jump out at me that are kind of lingering out there. I know in the lead-in, Haley asked if there are some, things lurking beneath, like the student loan repayment, that getting kick-started. That's something that we haven't really seen the effects of in the market yet, and that could potentially, when coupled with rising housing costs and rising car and credit card payments, et cetera, could be significant. I doubt most people that had those loans on deferral, save that money during that downtime. They probably went and filled that gap with some additional credit card bills or whatnot. So it'll be interesting to see if that has a real seismic shift in spending. We talked a little bit on the Market Pulse webinar last week about the depletion of people's savings coming out of COVID now, kind of going back to pre-pandemic lows. And so, again, we haven't seen that in the spending numbers, but I could make a case that we probably will over the coming 6 to 9 months. You hit on the job stuff, which I think is relevant. And I agree with you, here seeing 3.8% kind of jumped off the page, even though really it shouldn't. It's still sub 4%. And if you look a little bit deeper, the data on the jobs and unemployment came out last Friday. There was 29 months in which job growth hadn't dipped below 200,000 when seasonally adjusted. And the last 3 months have fallen short of that mark. So I think we've seen a little bit of a trend there, or at least enough months to say that there's probably a quantifiable cooling of the market. And if that continues to go up, unemployment gets to 4.2, 4.5% over the next 6 months, that might change the narrative a little bit. Some of the other stuff this week, Boston Fed President Susan Collins made a couple of statements, which I thought were interesting. A couple of her quotes. One, the U.S. economy will start to soften as the year draws to a close, and then the weak growth will persist into 2024. Pretty bearish in terms of what her thought process was around just overall market. She also echoed the sentiment here: household excess savings from the pandemic are declining, and business cash levels are also returning to pre-pandemic trends. Demand should slow as spending becomes more interest sensitive. So I don't know how much we read into that. We've quoted several of the Fed presidents over the last several months, and to my knowledge, none of the things they've said have immediately played out in the marketplace. But I think it does show that they're at least recognizing that there's a softening in the marketplace. And then just maybe lastly, you mentioned the ISM report. Just to get some context there, the index was at 52.7% in the prior month. It jumped up to 54.5%. And ISM is a barometer for U.S. business conditions at service companies. Really, restaurants, hotels were strengthened in August. And so it's the highest level it's been since February. And then we have a couple of other stories that we can talk through with WeWork. We mentioned that about a month ago around potential bankruptcy for that firm. And their CEO sent a letter out this week basically saying they're going to renegotiate all of their leases. And, bankruptcy probably is going to happen in short order for them. So that's something that could have some ripple effects. And, the signature bank stuff that we talked about, starting to see a lot of activity around that in the marketplace over the last week.
Yeah, I think those were all great comments and context of where we are. As I was listening to your thoughts, it just kind of dawned on me. I wear several hats. Sometimes I wear the humanist hat, and I think about the man on the ground and Joe Sixpack and what he's paying for groceries and so forth. And sometimes I think I put my Mr. Market hat on, and I think just about financial conditions. And certainly my open was of the latter thing, talking about what the broad U.S. economy is going to look like. But, some people that may sound callous. And I just kind of dawned on me as you were thinking that, even though we may have a soft landing, we do see people depleting their savings. We do see people having their credit cards run up. We know that those interest rates are high. We know that housing costs are really through the roof, whether you want to buy or rent in most markets. While there has been a leveling off, we haven't seen a huge retreat from 2 or 3 years ago. And so, for people that are living paycheck to paycheck, I certainly don't mean to sound callous. I think that those inflationary numbers we've seen over the last 2 years have really taken a bite out of people. And a soft landing doesn't mean that there won't be some pain to be felt along the way. And that's certainly the case. I just keep coming back to that $17 hot dog. Every time I think that I'm losing my perspective, I come back to the $17 Five Guys hot dog that I got in Manhattan a few weeks ago. And that does a little bit to keep me grounded.
I saw some stuff on Twitter this week. Someone was saying they went to lunch in New York and it was $170. I'm just thinking to myself, to your point, man, as we were complaining about a $17 hot dog or a $25 Five Guys burger and fries combo. Some people are out there spending a couple $100 for lunch. Maybe one day I'll be at a level where I'm spending $200 for lunch, but I doubt it.
Yeah, I mean, let's face it. The average guy who's living paycheck to paycheck probably relies on fast food quite a bit, and the prices of fast food have gone up, by 100% over the last year. Right, a $5 meal is now a $10 meal. That does have an impact. On the bright side, I think in many cases the wages of these people have gone up. We've seen a raise in minimum wage, and we've seen people really competing to get workers in, and that means sometimes signing bonuses and substantially higher per hour fees, and that's a good thing. But that cost of food really hits home for those at the lower end of the economic spectrum.
And we also saw the FDIC sale this week. Manus, break that down for us.
So this should be very interesting. This FDIC sale is being handled by Newmark. Billions and billions of dollars of assets that were seized through the taking over of Signature Bank, a lot of New York City commercial real estate, and some C&I debt in there, it will be a bellwether, I would say, in terms of where this comes in terms of sales price. It'll be a bellwether because of its size. I think it'll be a bellwether because it's New York City. It'll be a bellwether because it's office in some cases. So all of that, I think, will get people's attention. When these numbers come out, I think there's two things to look for. On the one hand, a lot of this stuff was performing. Very little of this, when you go back to Signature's last call report filing, which was in the spring before they got seized, their assets were performing pretty well. The stuff that was seized, you're not seeing a lot of non-accruals in there. So it's not like the people are buying deeply distressed assets in terms of cash flow. On the other hand, the sentiment for what's in New York is dismal. It's dismal in the office space, and it's really dismal in the rent-controlled, rent-stabilized area. We've seen comps there come in really extraordinarily low. They're low because the city of New York has capped rent increases well below the rate of inflation. They have hit landlords with mandates to improve their properties. And the truth is, a lot of these owners are tapped out, right? There's not a whole lot of demand for these assets. So if these sell at 85 cents on the dollar or 80 or 75, it's not so much because the borrowers have not been keeping current on their payments. They have been. It's because they think that the underlying collateral is not nearly as valuable as it was 10 years ago, number one. And number two, that you're probably talking about loans with handles of 4%, right? 4% interest rate loans that are trying to be sold in a 6 or 7% interest rate environment. But we'll be watching this carefully. We're looking forward to these numbers coming out, and we will certainly parse them once Newmark puts out anything publicly on the sale.
Yeah, it was really interesting, man. It's the FDIC put out a press release this week highlighting the component of this in New York, most notably the rent control multifamily. So they say the FDIC has a statutory obligation, among other factors, to maximize preservation of the availability and affordability of residential real estate for low to moderate income families. They're going to support this obligation. They're going to place the rent stabilized or rent controlled loans in one or more joint ventures, with the FDIC retaining a majority equity interest in the JV. In addition, the JV operating agreement will provide certain requirements that facilitate the financial and physical preservation of these loans and underlying collateral. So, there's definitely some nuance to that portion of the portfolio, and they're kind of priming the pump, I think, for that to maybe take on a slightly different off-ramp than what some of the other loans probably will encounter. And so it'll be really interesting to see if there's any interest, even with the FDIC playing a more active role in those particular properties and dispositions than they would maybe in some of the others, for the reasons that you mentioned.
Well, this gives me a chance to recommend to our listeners, if you haven't checked it out already, we had an interview with Bob Knackel a couple of weeks ago, and this was a big topic of conversation, how we use land in the city for housing and how poorly that land is utilized. It was a great interview. If you haven't checked it out yet, please do so, because I thought his comments on this particular topic were both timely and insightful. So one of my favorite interviews over the last couple of years that we've done. A really interesting guy.
So let's turn to our property type stories. Why don't we start with office this week?
We have a lot to go over, and some of it is actually positive. Some pretty positive stories among our list, including some in California. So let's start with the California first. The top story comes from the San Francisco Chronicle. AI company Anthropic is close to taking on 230,000 square feet of space at Slack headquarters at 500 Howard Street in San Francisco. It seems like every San Francisco story we've told in the last 2 years has been either a story about sublease space coming on the market or a property being sold for 40 or 50% of what the property was worth 5 to 7 years ago. This is a real green shoot here. I know there's been a lot of enthusiasm for AI nationally It has helped lift the stock market. It did so in May, and it did so again in August. People are very excited about where this can take us. There have been some positive stories that AI firms are starting to look for space in that Bay Area. And this is the first substantial evidence of that thus far. 230,000 square feet by Anthropic on Howard Street. We do have two recent sales that I'm happy to report. The first one comes from the Mercury News. I think this is George Avalos that reported this. In Milpitas, California, a 580,000 square foot property that is occupied by Western Digital has been sold for $192 million. The sales price there equates to about $330 per square foot. The buyer is Blue Owl Capital. The property does not back any CMBS debt. And a sale of similar look and feel. This comes from Commercial Property Executive. A complex in Fullerton, CA has sold for $76 million. This is a 400,000 square foot property, which is occupied by defense contractor Raytheon. The sales price equates to about $188 a square foot. The article notes that that price is slightly below where buildings have sold for recently in that market. They claim that the average is about $202 per square foot. The sellers there were Hines and Oak Tree. The property, again, does not back any CMBS debt.
Yeah, I think some good stories there on the office front. I mean, the stuff in Fullerton going, near the $200 a square foot, which is what the market average has been on sales comps. I don't know on this one if there's maybe a little bit of economy of scale here, since this was a 400,000 square foot property, or the fact that it was occupied by Raytheon. It might have a long-term lease with below market rents or something that maybe justifies slightly lower price per foot. And I echo the sentiment on the San Francisco story, although it's really interesting, man. It's like this AI stuff is now kind of hitting mainstream. And so we're starting to see people take on new space and grow out their footprint with these AI hopes. And it kind of seems to me like we had a very similar trajectory with this Web3, the NFT, the crypto stuff, not that long ago. I'm hoping that the AI is more substantive and leads to some upside for these firms, but it does ring very similar to me when we start seeing some of the aggressive activity around AI relative to what we've seen with some of these other technologies over the last couple of years.
I have to say, I was stunned by the amount of square footage that this firm was taking. I have this picture in my head. Maybe this is a terrible picture. At 230,000 square feet, that's nothing to sneeze at. I mean, a lot of big law firms, don't have 230,000 square feet in a city. So I have this image in my head that all you need if you're an AI firm is a blender, right? All this data is out there. All you need is one big supercomputer, the kind you'd see in a 1950s, sci-fi movie with the big tapes, right? Rattling all the time. And all you need is all this stuff kind of going into a blender, and it all comes in and goes out again. You don't need any human beings monitoring this. Once you build the algorithm, you just kind of set it to go, and that's it. So, I was expecting these AI firms to be taking 5,000 square feet, 10,000 square feet. I certainly wasn't expecting that kind of number, but who's to complain, right? If we have 3 or 4 of these AI firms in several of the major 24-hour cities taking that kind of number, we'll take it, right? That could be a real balm for the office market.
Yeah, I agree with you on the image. It's almost like we've seen in the movies, you're supposed to go into a separate room and see the AI machine, not have a bunch of people. I think what will come out on some of these is a lot of this technology is still human assisted AI, right? So they maybe have certain components that are machine driven start to finish, but some of them are still assisted with human intervention, or there's some protocol in place. But any story with 230,000 square foot being taken down in San Francisco in today's day and age is a really, really good green shoot story.
I don't want to disparage Anthropic in any way, shape, or form, but the more I get into this image, the thing that keeps popping up in my head was Theranos, right? You're supposed to take a drop of blood, you throw it into this, spinner, and it comes up and it tells you when you're going to die, right? It's like, what do you need intervention for, right? There's what do you need people for? And what it really was, it was the bird in the Flintstones camera knocking out the photograph on a piece of stone, right? It wasn't any technology. It was people sending things off to laboratories, right? There was no special sauce. And I just wonder if you get these AI firms where these requests come in and there is no big machine there. It's somebody, jumping onto Wikipedia at 1,000 miles an hour and coming back with some kind of term paper for a student at South Carolina. I don't know. We're going to find out, I guess. It's just a matter of time.
Yeah, we'll find out if we're replaced here the next month or two with one of these aggressive AI firms that says we have enough recording of Lonnie, Haley, and Manis at this point. We can replicate the TreppWire podcast. We don't need you yahoos anymore.
Wouldn't that be hilarious if it's actually just a bunch of guys at cubicles?
And we had 2 more office stories.
Yes, these were not nearly as upbeat as the first 3 that we came out with. We put out a trading alert. A TreppWire correspondent pointed this one out to us. In Louisville, LG&E will be vacating its space at 220 West Main in that city. The story comes from the Louisville Courier-Journal. The property itself backs a 2015 CMBS loan. The entire square footage of the property is almost 300,000 square feet. LGE is the top tenant with more than 70% of the space on a lease that ends in 2025. That same year, the loan matures. The loan is a $21 million CMBS loan. And, this is one of those things that will make this a challenge to refinance. When you have a 70% hole, unless you fill that 70% hole, or at least maybe 50% of that 70% prior to having to refinance this thing, this is going to be a challenge, right? You're going to get to 2025. You will either go to banks and get rejected, or you'll go to banks and have to come up with a story that you're going to have a pay-in refinancing. And in this case, it might be a substantial amount. And I do think that as far as the office space goes, this will be the narrative for the next 2 or 3 years, that unless you have a lock, stock, and barrel 90% rent roll with at least 3 or 4 years remaining on these leases, the challenge will be there. If you have a story to tell, which is you're not sure the tenant is going to be there, or you have a big hole to fill, I think it's going to be either extend and pretend or the keys go to the lender. We'll see. But thank you for that from our TreppWire correspondent. In Atlanta, this is from the Atlanta Business Journal, 3 Ravinia in that city has sold for $175 million. This property is the home of IHG Hotels. The buyer of this 820,000 square foot office is Esteen USA. The price equates to about $213 a square foot. Esteen assumed a $115 million loan as part of the sale, and the seller was Blackstone. Why was this a negative story? Normally a sale of this size would be a green shoot. It's kind of a crabgrass, because in 2016, Blackstone bought the asset for $210 million. So a 17% markdown over 7 years. But it does bring me to a point, Lonnie, and maybe this is a very brief educational segment, that in this particular case, Esteen assumed a loan, $115 million. We're going to have a couple more stories later in this episode of other stories that a sale took place with an assumed loan. And an assumed loan right now, the ability to give somebody or port over a loan to a new buyer at a below market rate is a real asset right now. I'll let you get into the math in a second about this, but for those who are out there who are users of the capital markets, if you don't negotiate the ability to let somebody else assume this loan, you're probably missing out on an opportunity. I wish we had said this 3 years ago when rates were at 2.5%, but if you're in the market for a loan, there's probably 2 things you should always ask for. You may get rejected, but you should ask for it. One is, can I let a buyer of this property assume the loan? If you win this point and you're trying to sell a property and you can give the new buyer a loan which is 2% under market, you're going to get a higher price for that asset than you would if they have to get fresh financing on it. And the other thing, this comes from one of our correspondents in Texas, just another parenthetical. If you can win the point that allows you to buy back your own debt, that you could be the acquirer of a note of your own loan rather than it going to, let's say, 10X or Real Insight Marketplace. That too is an asset. You may not win that point either in your loan negotiations, but just two things that popped into my head with this story.
It's very timely given where we're at in the cycle. The challenge is just, to your point, a lot of people over the last 3 to 4 years probably were so focused on just getting transactions done. The money was super cheap. Values were really high. They were able to procure a large, amount of debt with minimal due diligence relative to the scrutiny they're under now. They weren't really negotiating or focusing on some of the finer points of the deal. But it's a valid point in the sense that it gives you options. And what we're seeing now is people that have those options and are able to exercise those options do have a competitive advantage in the marketplace. And in this example, if you can assume a loan that has some years left before maturity at below market financing rate, a buyer is going to be willing to potentially pay you more for that today than they would if they had to go out and get current interest rate financing. And so, I would say downturns, we've joked that banks are going to make the best loans they've made in the last 10 years over the next couple of years because of the drawdown on liquidity and just the due diligence they're going to put things under. You're going to have probably more attorneys and more people reviewing your loan documents now than you would have 18 to 24 months ago. But it's really good hygiene, even in good times, to make sure that you're putting some of these covenants in place. And as Manus mentioned, if you don't ask for it, no lender is going to offer that to you. It's kind of a proactive thing. You have to take the proactive approach and say, we want this put in the agreement. We did a piece probably a year and a half ago at this point, Manus, where we looked at the amount of prepayment penalties that people were paying to get out of their existing loans at that time. And I think for multifamily in some markets, it was like 6 or 7% of the loan balance, and people were still taking properties to market and buyers were still paying and everyone was happy. Now, with everything that's taken place, if you're an office building that maybe is struggling with occupancy or has other issues, this might be the linchpin that gets a deal done. So definitely something somebody should try to negotiate for if they're given an opportunity on the front end of a deal.
Yeah, I mean, just if you're just thinking about the math, if you have $100 million property and to get fresh financing on it would cost you 7%, and the existing loan has 5 years to go, and it has a 5 handle, it's a 5% rate, let's say, that's 2% savings per year. That should equate to a $10 million, at least if you PV it back, it's less than that, but it's a $10 million benefit that you have that should accrue to your bottom line in terms of a higher price point, right? All things being equal, if you're considering buying something else where that option does not exist, right? Of course, there's a lot of nuance to these numbers. Rates move all the time and so forth. But the next time rates go down to 3%, if you're in the market for a loan, try to fight really hard for that ability to slough it off on somebody else. I think it's worth your effort.
Yeah, so Manus, we had talked at length about the rate cap stuff, 7 or 8 months ago, and that was kind of a hot commodity. And people that had rate caps, there was actually positive value in those caps that they could trade on the secondary market. This is the exact same type of example here. So good advice, and hopefully some people will see this disruption in the market and maybe be a little bit more diligent on some of their document prep in the future.
And on the topic of assumptions, we saw a similar scenario with a multifamily story. So let's dive into that.
Yes, this is known as in radio as a great segue because it kind of goes hand in hand with this assumable loan notion. This is an example. A New York apartment was sold for well above asking price. The story comes from Commercial Observer. NYU has acquired a luxury apartment complex for $210 million. The apartment complex is known as the Lanthian. The price is about 25% above what the asking price was back in April. In April, when the complex first hit the market, The Real Deal reported that the owner, Verbena Road Holdings, which is owned by Dennis Wong, was looking for a price of north of $170 million. All of the apartments are market rate. The sale was packaged with a $103 million assumable loan that was originated in 2019 And this has to be an asset. This has to be something that contributed to the reason why Verbena got $40 million more than they were asking for. The price equates to a little over $1 million per unit, and it is in Manhattan's Kips Bay neighborhood. So here's a bona fide example of somebody taking advantage of, what was probably a pretty low rate when this loan was originated in 2019.
Can you imagine being on the seller side of this, Manus, given all of the negative headlines and everything that they've seen in the marketplace? Back in April, you're looking at a price, 170 or so. You take this to market and you get 210, all things considered. Either you feel so emboldened by that you just take that money and immediately go buy multiple other properties, or you realize that you've hit the jackpot and you just cash the chips in and go retire somewhere.
Yeah, I don't know. It's the tale of two cities in Manhattan. We started off at the top of the broadcast talking about that FDIC sale and how much of a struggle it might be for that rent-controlled, rent-stabilized segment of the market because of the rent increase caps and the mandates and so forth. This is the polar opposite of this. 100% market units. We saw the headline last month. Manhattan had hit all-time record high in terms of price per month per unit. And this, in addition to the assumable loan, this is also a function of a market that just does not have enough supply and for which there is seemingly endless demand. And the amazing thing to me is when you bundle all of these ideas together, the 3 days per week work in the office, the quality of life headlines that you see every single day about Manhattan, whether it's the subways, the migrant crisis that seems to be really getting under the skin of Mayor Adams these days. Every single day he's talking about it, and the crime. It's really a stunning headline that these rents are at all-time highs. There are a few things that over the last few years have astonished me. That's one, the student housing, the fact that people sent their kids back to school to sit in a dorm room for 2 years and pay full boat, the $17 hot dog. I guess those are the three big things that just never stop astonishing me.
We want to do a year-end blog, Haley, on the Manus top 5 things that are astonishing.
Well, our old host, Joe, used to want me to do a segment, things that stick in your craw, because there's always something that I would be mentioning week after week that was happening. It could be somebody talking on the quiet car on the train, or people that don't walk in a straight line, in front of you, that type of thing. It's just, there was always something every single week, but it made me sound a lot like Clint Eastwood in Gran Torino. Like, I don't want to be that guy. I'm not an angry guy at all. So I do have one other not so happy story in the multifamily segment. This comes from the Baltimore Business Journal. Fannie Mae was the top bidder in a REO, foreclosure sale of a Baltimore set of assets. It's 5 different buildings, but the big one was a 392 unit Centerpoint Apartments at 8 Howard Street in Baltimore. The bidding there opened at $45 million. Fannie Mae, to protect its credit bid it up to $48 million, and they were the winner of the foreclosure auction this week. So there were other people trying to get this asset from Fannie Mae and kind of take it over. So I guess that part of it is good news, that there is some demand for this property. The disappointment comes from the fact that this particular property was purchased by FTP Centerpoint in 2013 for $75 million. So you're talking about, I don't know, close to 40% drop in value for this property. And it comes on the heels of 2 or 3 really negative office comps in Baltimore over the last 6 weeks. So this is more of the same, right? It is in San Francisco, it's a lot of negative price discovery going on there. And in Baltimore, the same thing. I don't know if it's anything to do with the Harbaughs, right? They both used to coach the Niners in the case of one of them and the Ravens in the other case, but I won't blame them specifically for those problems.
Yeah, I think it's interesting. Baltimore seems to me like St. Louis. We had a lot of stories last week on the podcast that Stephen and I covered around St. Louis, and it's very similar, man. It's office, multifamily, kind of same story. So hopefully for Baltimore, we'll start to see some improvement there. I know there are some new developments coming in, a lot of retail. There's some things trying to reinvigorate the city, but there's a lot of negative headlines relative to transactions as well.
It's a very sad story. The city, in many ways, like New York, had gone through a renaissance in the 1990s. They had built up that Inner Harbor area. It was a really delightful place to go. Camden Yards opened, great restaurants, great vibe. And now it's become really overrun, I would say, at least the last time I was there, which was 2 or 3 years ago, with crime and homelessness. It's a real shame because, 25 years ago, it was a really terrific place to be.
And this week we saw a story in the retail sector where changes for a mall loan were becoming a reality.
Yes, I missed 2 weeks. I missed last week's podcast, but 2 weeks ago, I rattled off several stories that were coming out of special servicer comments about malls. We put that into a blog. Haley distributed this last week. I think we made it a freebie. So if you're interested in it, we're happy to share it with you. I think Globe Street picked it up as well. But for every negative story that we've been hearing, like Tuttle Crossing with that $15 million top bid, or the sales price of the Las Catalinas in Puerto Rico last week that Lonnie and Steven reported on, for every one of those, there seems to be one positive story, somebody fighting for an asset, working out a long-term extension, putting some cash into it, or in some cases, the mall being bought and taken over without any discount. And that's what this next story is about. Our trading alert came out a couple of days ago. We wrote that the property behind the $195 million Valencia Town Center loan had been sold for a price that was slightly higher than the loan balance. A 50% ownership in the mall was held by Westfield, which is now Unibel, Radamco, Westfield. The other half, I believe, was still owned by Teachers. At least they were the owners when this loan was made in 2013. The loan had missed its maturity date in early 2023. The loan made up 73% of the collateral behind a 2013 deal. The property was valued at $398 million in 2013. The value was later lowered to $181 million. Centennial has come in and now bought this asset for $199 million. The missing piece of the story that we don't know is what Centennial got in terms of loan extension for this. I think what is assumed as part of this sale is they negotiated something with a special servicer to take over this asset and extend the loan for another 3, 4, 5, 6 years, something like that as part of this. But this is of a piece. This is now the second or third or fourth story we've seen like this. I think the Bridgewater Commons was another similar story in New Jersey, where in that case, $300 million loan, collateral worth $200 million, buyer comes in, assumes the loan without any discount, extends the loan, and bondholders are now in a position where they might be made whole. Whereas before they were looking at a 6 or 7 or 8 figure loss. So positive story here. Centennial's come in. They value this thing at more than what the loan is worth. And maybe holders of this UBS deal from 2013 come out whole over time. So, and Haley, let's make that a freebie as well. If people want to see this story, we're happy to share this.
Sounds good, Manus. Email us at podcast@trepp.com or send us a DM on Twitter at TreppWire, and we'll get back to you shortly. And we have a hotel story this week about a New York hotel that was sold.
The Commercial Observer was reporting just a couple hours ago on Thursday, September 7th, that the debt on the New Yorker hotel has been sold for close to par. So the debt on this hotel is $106 million. The loan is said to be performing. The seller of the note was M&T Bank. Newmark handled the sale itself. The note does not back any CMBS debt, but I thought the most interesting part of this thing was the close to par sale price for this thing. Anytime in this kind of market where you see something in a struggling market, which the New York hotel market is, in a situation where interest rates are higher and thus cap rates are higher, you would think big discount. And the fact that this is not a boutique high-end hotel. This is right by Madison Square Garden, somewhat dated, not a super high quality of life part of the neighborhood. For a loan of this type to go for close to par, which is quote unquote, how it was reported by Commercial Observer, I think that's a green shoot. The buyer of the debt was Yellowstone Real Estate Investments. The property itself, 1,000 keys, about 140,000 square feet devoted to student housing, 100,000 square feet of office, and some street level retail. So a little green shoot there.
Yeah, I wonder on that deal, Manus, if maybe some of that additional square footage, attributed to student housing or, office potentially helps this property in the marketplace, at least perception wise. I don't know about the street level retail or the office stuff right near Madison Square Garden. I think that market's it's probably seen better days, but maybe there's more to the story here. I would agree with you though. We've probably talked about 6 or 7 of these types of deals across the different asset classes over the last few weeks where, close to par has been the narrative. All in all, it's probably better than what we would expect. It'd be interesting. I know we had been working with some folks at Newbark about maybe having them on the pod. And at that time, there hadn't been a lot of activity in the marketplace, but I think we've seen enough of these stories now. Maybe interesting for us to get some perspective from them in terms of where some of these deals actually have played out beyond just the headlines.
Yeah, I don't know anything about Yellowstone, honestly. So I don't know what their plan is. But when you see something like this, there's one of 2 things that's going on. I know that I think that this loan was like a 43 LTV, something like that. So it's kind of under levered. So either this, close to par, if they bought it at a 96 or a 97, something like that, they're getting a yield that they think is commensurate with the risk that they're taking. Perhaps that's their plan. But sometimes people buy these things with a hope to own, right? They say, we'll get paid our 8% yield or 8.5%, whatever we get for owning this note. And if things go south, we'd love to own this asset. But as I said, I don't know Yellowstone well enough to know that if they're a distressed asset buyer just to hold income or if there's something up their sleeve. It'll be interesting to see how this plays out.
And finally, we have one industrial story. I know this will make a lot of our listeners who have asked for this property type happy.
Yes, we have a really loyal listener group that we disappoint regularly. They love for us to do more industrial stories. We don't do a whole ton, but my September resolution will be to at least give an industrial story or 2 every month. I think we even need like either a drum roll or maybe some lead in music, or maybe we can get Billy Joel. We can, living here in Allentown, maybe kind of play that lead in to our industrial stories going forward. We do need to give it a lot more love. Anyway, this comes from the Mercury News. Westcor has acquired 3 industrial properties in Livermore, CA for $327 million. The sellers were Bentel Green Oak and New Tower Trust. The properties total 1.3 million square feet across 3 different industrial assets. That price equates to $252 a square foot. 2 of the properties are occupied currently by Tesla. And, if I'm going to give this any context, it probably echoes what Lonnie said 2 weeks ago. That $250 a square foot industrial price is nice, right? These things used to go for, 70, 80, 90. This is 3 times what these things were getting 4 or 5 years ago. And just evidence of strength in that market.
Yeah, so I made a note here. We're going to talk to Simon H about getting, Billy Joel or somebody to come do some intro music for us. So we'll add that to his list of podcast expenses in this upcoming budget. But yeah, just to give some additional context, man, we covered a couple of office stories today out in California, $188 a foot, $330 a foot. You got some industrial properties here trading, at $250 a foot. I mean, if you're in the industrial space, Tesla as a tenant seems pretty appealing to me at this point. And I think this is a really great sale. And we will, as Manus mentioned, make a more concerted effort to talk a little bit about industrial. And we have a couple of other listeners that have reached out about LA-based multifamily and a few other areas that we've neglected. So we'll try to start weaving some of those user requests. I feel like a DJ at some point. We're gonna start playing some songs by request. But we appreciate the email correspondence, and just know we read them, and we will try to incorporate some of those stories into the upcoming pods.
Yeah, I could see Simon signing off on maybe a Billy Joel impersonator, something like that. I'm not sure he's going to go for the real thing.
He probably knows someone named Willie Joel that he'll sign up. Yeah.
And a programming note this week. Next week, Manus, you will actually be taking part in a webinar with the Mortgage Bankers Association. So on Thursday, September 14th, Manus will be on the panel called Value of Surveillance in Managing CRE Credit Risk. He will be alongside panelists from across the industry and one of our loyal podcast listeners and friends, Deborah M. So reach out to us if you want the link to sign up for that.
Yes, I'm looking forward to that. Deborah M. and I go way back. We're constantly comparing notes about the state of the market. She's been doing this for a while. She knows her commercial real estate. The rest of the panelists as well. It's a great group of people, and I think it'll be a spirited conversation. I'm looking forward to it.
And shout outs, Jason K thanked us for our informative webinars. He said his firm is continually using Trepp's Insights podcast and webinars for their research. Tyler T sent us a shout out from her client, Jesse N. He said he loves our client only newsletter that he gets every day and never misses an episode of the podcast. And he was another one who asked for more industrial coverage. So more to come, Jesse. Jeff W, who I mentioned last week, thanked us for his shout out. But he also mentioned he's looking forward to the TreppWire live at the Wynn in Las Vegas. So just for some background, Manus doesn't listen to this podcast. He does it once and then he doesn't listen back. So I don't know if he actually heard us joking last week that you were in Vegas trying to get us a residency there.
Well, it's funny because I go to Vegas most years. I go with about 6 to 12 guys I grew up with that I went to elementary school with and so forth. And I'm going at the end of September 21 to 25. It's a great couple of days of steaks and football and pool and so forth, getting to see guys that, I've known since I was 7 or 8. And I say all this by way of saying, if you are a Vegas resident and a podcast listener, if you'd like to get a cup of coffee during those times, later in the day, better than earlier, given the nightlife we like to enjoy when we're together. But if you'd like to have a cup of coffee, reach out to me and I'll be happy to do so.
And Yanshu L said, Yanshu L was looking for multifamily expense ratio reports. On Twitter, we had Hathshire Berkaway, who shared a clip from our episode with Bob Knackle. So as Manus mentioned, that was episode 212. You can go listen to that one. And David E recommended our podcast. He is a loyal listener as well. And then finally, guys, I don't think we could end this without mentioning that the NFL is back. For me, that means I get to make my dips and my wings and my chili, but it might mean something different for you guys. And I know you're very excited.
Well, let me start by saying, we're always looking for alternative ways to expand our reach. I do like the idea of having Haley's TreppWire branded buffalo chicken wing barbecue sauce, available on shelves everywhere. I like the idea of expanding our brand. It's something different. I'll go with something. I write TreppWire. I've been doing it since 2009. Most of you get it. It comes out at 6 o'clock in the morning every business day. And I drop this line every year around this time, as I have for every year since 1972. I'm picking the New York Giants to win the Super Bowl.
Well, I'm a Dallas Cowboys fan, so we're going to play each other week 1, Manus. I would be happy if either of our teams won something. It's been a while for both of us, longer for me than you. I remember being a kid in the 90s and watching the Cowboys games was like magic. It was like we killed everybody. Every week was a party, Super Bowls every year. At least that's what I remember as a kid. Now we're like praying to make the playoffs and can't get out of our own way. So I'm excited about the football season, but I know I'm just delaying the inevitable in my hope that the history won't repeat itself and the Cowboys leave me disgruntled at the end of the season. So I'm excited about some of the changes, though. Aaron Rodgers with the Jets, that's going to be exciting. There's a lot of new faces, a lot of new players, new quarterbacks that were drafted this year that are going to be starters. And so it'll be interesting to see how things play out. But I'd be hard-pressed to bet against Kansas City, given just what they have with Patrick Mahomes and the rest of that team.
It'd be interesting to see, Haley, don't you think, Lonnie as disgruntled Lonnie? Like, I don't think we've seen disgruntled Lonnie on the podcast.
No, we haven't.
It would be an interesting look.
Well, we hope that doesn't happen.
Yeah, there's only a few things that can get me fired up, and unfortunately, I haven't outgrown the Cowboys yet. Although I tell myself every season that I'm gonna let it go and just move on to a new team. And even my Rangers, my Texas Rangers, they were in first place most of the baseball season. Super excited about them heading into the playoffs, and they've lost like 15 of their last 20, and now might not even make the playoffs. So it's not been a good sports season for me so far.
With that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.